Hi everybody, this is Tom Long. Welcome to this webinar is multiple time frame analysis. Now, I know that in the last webinar we left it off really talking about trends and identifying strong trends. There's two reasons for that. Number one, I knew this webinar was coming up, but number two, I really am a believer in that. I mean, that is really how many of us identify our trading opportunities. And we want to not only just touch about that, but we want to delve into a little bit deeper, because this is one way, if you've ever bought a market and have it turned on you quickly and turn into a losing trade, and you thought, I don't get it, I thought the market was moving up, then this is the webinar that you want to pay attention to, because this is how we can confirm, or at least attempt to confirm, everything is an attempt, how we can attempt to confirm that we've got the momentum on our side on multiple time frames. Because anytime we can do that, we just increase our chance of success. And as I'd mentioned before, as traders, our goal is really to win about half of our trades and to make more when we're right than we lose when we're wrong. And by making sure that we have more than one time frame working in our direction, otherwise the momentum on multiple time frames are in the same direction and we're trading in that direction, that just increases our chance of success. And even if it just moves it from 45% win percentage up to 50% win percentage, at the end of the day or at the end of the month, that can be an incredible difference. So that's what we want to get into here. And of course, as usual, we're going to start off with the risk disclaimer. I know you've heard this many times, and guess what? You're going to hear it one more time. This, of course, is speculative investing. It's high risk, high leverage. Of course, we have the ability to determine how much leverage and how much risk. And of course, that is what we've been talking about here for the last couple of days. To be fair to yourself, give yourself a chance to stay in the game long enough to where you can get some momentum, get your feet on the ground and get moving, and learn a little bit more about what makes these markets move, and more importantly, learn how to identify that and take advantage of it at the same time. But we have to understand that there are credible gains. Incredible gains mean incredible losses. It is indeed a dual-edged sword. You can't have one without the other. You might be able to convince yourself that you can, but in reality you can't. Now what we're going to do here over about the next 45 minutes is learn how to analyze a currency pair as it is moving simultaneously through several time frames. We want to learn how to fine-tune or time the entries so all time frames are aligned at the point of execution. Thank you for joining us, Steve. Learn how the momentum of the shorter time frames and feeds into the direction of the momentum of the longer term time frames, and learn that by employing this method when the trade is entered, it is more likely that the full force and momentum of the market will be behind it, thereby leading to higher probability trading. And of course, most of you can see that Steve has to leave us. Thank you very much for joining us. Sorry you couldn't stick around till the end, but I do believe your name is still in that that bonus pool for tonight. So good luck with you on that. Now, this is a map of New York. We know that mostly because some of you may have recognized it, but I'm telling you this what it is. You know, this is what's called taking a step back. You know, one of my problems with traders who trade on the short-term charts is that they really don't take a second to take a step back and see which way the market, its natural flow is, you know. And I liken it to watching a football game. Now, when I say football, I mean American football. You may think of what we call soccer. It doesn't matter. It's the same concept. But watching it on television and having your nose right up against the screen, you have an excellent view of what's going on into about a 3 or 4 inch area, but you really have no idea what's going on around you because your peripheral vision is limited because your nose is touching the screen, and which is really a shame, because sometimes these matches or games, the real beauty is to see what the players are doing who aren't near the ball, who are far away from the action, but they're reacting to what's going on maybe 20, 30 yards away. That is really the beauty of the game. If you've ever been to a hockey match, it is kind of a difficult game to watch on TV, but if you're live watching hockey, it's incredibly fast, and you see what's going on with the changing of the lines when the players come off and go on the ice. Okay, we're taking a step back to take it all in, so we have an idea of what's going on. And We just want to make sure that we think about that when we're looking at a short-term chart. We can really focus on what's going on in the short term, but in order to be a complete trader, we want to have the ability to kind of take a step back and see what's going on. It's the old, see the forest through the trees. Just take a step back so we can see what's going on. Now this is taking a step back, and it's telling us something, but it's really not telling us enough about what we need. Now we're taking a closer look. This would be more like the intermediate term. That first chart would have, or that first picture would have been more like starting off with the daily chart to see what's going on, or the weekly chart. And now we've gone down to a shorter time frame, like a 4-hour chart, to get a better idea of what's going on. Maybe not so much the here and now, but maybe on the daily chart we're looking at what's going on as far as the monthly momentum. Here we're taking a peek at what's going on the weekly momentum, and then we want to move down to a shorter time frame chart, or in this case, a picture of downtown or in Manhattan, in New York City, to kind of get an idea of what's getting up close and personal. Okay, but we've taken in multiple ways of looking at the market action, so we can kind of process that information and use it in our trading decisions. And it's exactly the same thing we want to do when we're looking at charts. Whether we look at 3 time frames, which some traders do, my preference is just to look at 2 time frames. So we're going to look at both angles and kind of glean we can gather, what kind of information that we can gather from that. But looking at these pictures kind of gives us an idea of what we want to do. Some of you may or may not recognize this as a street corner in Manhattan. Others may. But if we looked at all 3 pictures, it kind of becomes clear what it is that we're looking at, and maybe the time of day or the month of the year or whatever the situation. Obviously, I see some people there. They're in short sleeves, so the first picture didn't tell us what the weather was like or what time of the season was. Neither did the second picture. But we're gathering more information because we're looking at it through 3 different windows, or time frames, if you will. So we get a better idea of what's going on in the city, and we can make decisions on how we want to react to that information that we're processing. Now, by looking at the 3 views, I'm confident that we'd all would agree that we have a better view, a better understanding of what the city is all about than if we just looked at one of those photos. This is precisely what we're talking about with multiple time frame analysis. And we'll have a greater understanding what the currency pair is doing, its pulse, its rhythm, its momentum, by viewing it through several time frames as opposed to just one. Now, right now I want to say is you've got to be very afraid of being over analytical. That is a term that I like to use because there are analysts and there are traders. Okay? Just make sure that your analysis leads to sound trading opportunities, that you're just not analyzing, just to analyze. If that's your game, and being a profitable trader is not why you're here, that's fine. Everybody's in the market for different reasons. Okay, we just want to be very, very clear about why we're in the market and set goals, set short-term objectives to reach our long-term objectives. And by looking at more than one time frame, we're just processing more information to give us a better idea of what the market wants to do. Because remember, as I like to say, we have no control over the market. It doesn't matter if we want the market to move up or move down. The market's going to do what it wants to do. It's our job as traders to recognize that and exploit it. Now, each currency pair is comprised of embedded trends, trends within trends. I think of these as breathing, living animals. And because as a matter of fact, what you see on the chart is really based on human emotion, okay, and human thought and human analysis. It's people who are making those decisions. So in a way, it is a living, breathing thing. And markets have a tendency to move too far in one direction or the other, okay? That's the good news, though, because that's what offers trading opportunities. It is our goal to find out what the overall mood of the market is. And when those markets have those short-term moves against what the overall mood is, that is a time for us to pay attention and to look for trading opportunities on the assumption, and it really is an assumption. We can call it an educated guess to make ourselves feel better, whatever we want to do. But as a matter of fact, we really don't know, and which is why a 50% win percentage is excellent. Okay, it is basically the money management that can make that into a profitable strategy. but we want to make sure that we're trading with the momentum, with the mood, or with the trend, because that gives us the audacity to look for more in gains than we're willing to risk on the trading opportunity. So it really works both ways. Now, multiple time frame analysis, being able to understand how the smaller time frames feed into the mid-term time frames and the mid-term time frames feed into the long-term time frames is the key to understanding this concept. And like I said, some people will use 3 time frames. My preference is 2, but we're going to look at both. We're going to take a peek at both, and we're going to kind of follow up, looking at the charts here at some live examples of some markets that are moving strongly, both right now and historically, because historically, gives us a really good idea of when the markets are really humming, what it looks like, and that's when we want to be there, right on top of it, to pounce whenever we see an opportunity. Now this little graphic here is just a beautiful thing. This is really what it's all about. I want you to notice that the trading between the 2 black bands would represent what's going on the daily chart. The trading that's going on the 2 red bands would be the 4-hour chart, and the trading that's going on with the green arrows would be on the hourly chart. Now, obviously, our goal in the perfect world would be to identify when the daily trend is down. Obviously, remember, we're trend traders, so we're looking for selling opportunities. And then we move to the 4-hour chart, and we see the 4-hour chart is also moving down. So now we're just making sure all of our ducks are in a row here to try to make sure that we're putting the numbers and the odds on our side. And then when we see that ABC move on the hourly chart, we pounce. We jump on board with a high amount of confidence, not cockiness, but confidence that we're finding and taking advantage of a solid trading opportunity. But still, the odds are we're going to have, it's not odds are, the guarantee is that we will have losing trades. So we also want to make sure that money management keeps us in the game. But I mean, this is the ideal situation we're looking for. I want to take a second and really kind of take a peek at this graphic, because this really does explain it all. If you're trading on a 4-hour chart and you're using an ABC here, remember, between the red, we've got the daily trend is down. We've got our A, B, C on the 4-hour chart, and we would sell on a move down through that previous low. Or we would be using our technical indicator to help us time our entry up close to this point C here. If we're trading on an hourly chart, we've got the daily trend down, we've got the 4-hour trend down here, and also here, and we can see more or less our ABC is what we're trying to note here with these arrows, is that markets don't move necessarily in straight lines. They inhale, they exhale. There are always traders out there who, even a downtrend, think they can identify the bottom. Okay? They can't. That is a mathematical fact. And to prove it, we can look at a different variety of indicators, not so much technical indicators, but indicators where they measure what individual traders are doing. In Forex, for instance, the firm FXCM uses SSI. Gain has their own. Oanda has their own, where they're looking at customer positions. And in the stock market, they look at the small options exchange. They call it the option ratio, the short interest. In the futures market, they call it the commitment of traders. Okay, everybody measures what the individual retail trader, that's you and me, are doing. Why? Because more individual retail traders try to pick tops and bottoms and trade with the trend. Okay, number one, that's good news. Let them do it, because as I said before, those are the people that are helping us get in and out of our trades equally, because as trend traders, we are buying when they are selling and vice versa. Okay, but these studies or indicators have really been around since they've been able to measure them, and they really got big with in the computer age, because it's easier to measure these numbers, and you can look it up. I mean, it is in every financial market in the world. They measure what the individual retail trader, and that is you and me, what we are doing, and the professionals try to do the opposite. Why? Because since the beginning of time, most individuals try to pick tops and bottoms. Excuse me, I'm giving myself tongue twisters here. They try to pick the tops and bottoms. But why do the professionals trade opposite? Because they know picking tops and bottoms is next to impossible. Oh, you may do it every now and then, but if you just want to be a now and then trader and have 2 or 3 trades in your career, that's a worthy endeavor. But if you want to be in it for the long haul, we have to learn to trade with the direction of the trend and to take advantage of that momentum. And that's exactly the kind of thing that we're seeing here. Now, it doesn't matter what time frames we're using. I like to use 2 time frames, and I like to use anywhere between maybe a 4, 5, 6 to 1 ratio. Meaning if I'm trading on the hourly chart, I like to use the 4-hour chart to find some strong trending moves. If I'm trading on the 4-hour chart, I'll use the daily chart. I know it's 6 to 1, but those are the 2 more popular charting time frames in those segments, and I want to take advantage of that. But even if I'm trading off of a 5-minute chart, I will take a look at the 15 or the 30-minute chart just to make sure that I'm trading with the momentum of the market as a whole and not kidding myself by just looking at this one, this trading sequence that I'm looking at and thinking that everybody is seeing the same thing, and that is the overall momentum of the market. Not necessarily. Remember in the previous webinar, we looked at that euro dollar. We're going to look at that again here in a minute and how strongly that's been moving down. So that means on a 4-hour or 1-hour or 2-hour chart, even down to a 15-minute chart, we want to make sure we're only looking for selling opportunities. Why? Because there are the sellers are in control of that market. And, we may think it's very, brave to sit there and stand in front and say, I know when the bottom is going to be, so I'm going to buy it right here. But, that's a good way to experience another losing trade. Take advantage of the flow. Take advantage of the momentum. That is one of the keys to successful trading. That is one of the things that we want to embrace. We want to use that as our edge because remember, again, it's a zero-sum game. If we are buying in an uptrend, we are forcing the trader on the other side of the trade to sell in an uptrend, and now he's behind the 8-ball. We've got the numbers on our side. He or she are working against the numbers. We want to be in that in every trading situation. Okay? It is pure and simple competition. And we want to make sure that we are trading the way the professional traders are trading, and they are looking to see what the individual trader is doing and pretty much doing the opposite. Now, they have other reasons for making their trading decisions, particularly the big producers. They may be exchanging currencies because of conducting business, but these markets are very heavy into speculative field because of the hedge funds and other money managers. And you better believe they know exactly what the individual trader is doing. And frankly, they are doing the opposite. We want to be like the hedge funds and the money managers instead of the traders who are offering fodder or the money for those traders who know what they're doing. Okay? And this chart really shows what we had talked about before with the ABC and how to fit it into the big picture. Okay, let's take a look at some live charts here and see what we've got going on. Okay, and this first one here we want to talk about, this is a weekly chart of the euro dollar. Some traders really like to start off with the weekly. I don't, but what works for me is not necessarily what's right for anybody else, and I'm okay with that, and you should be okay with that too. But as a matter of fact, since any time in here, it was pretty obvious in here that this market was screaming to the downside. I mean, we had 1, 2, 5, 8, 9, 10, 11 out of 12 weeks to the downside. I mean, what else do we really need, to confirm that this market is in a downtrend? I mean, it's moved down through all of these lows without really any problems, without really slowing down, and it's continued to move down at the same time. So we know that we want to move down to a lower time frame to make sure that we will look for selling opportunities. Now, in this case, we're going to look at 3 different time frames, which can be sometimes getting into the over-analytical stage, but yet there are professionals who do this. This is why we're doing it. And in the end, we're going to show you the 2 time frames, which is an easier concept to grasp and to use and to employ on a daily basis, and probably something that I would recommend. But again, this is the chart that we saw before that when we said in September, the market was obviously moving down on the weekly chart. Here's confirmation on the daily chart. Now, some traders would just simply trade off of this chart using the multiple time frame analysis. It's about a 5 to 1, which is just about where you want to be, meaning on a daily chart, there are 5 days in a week, so we've got that 1 to 5 ratio going on. We don't want the time frames so close to where we're seeing the same thing. We want them far enough apart so they're reflecting a different aspect or a different way of looking at the market, or really appealing to a different group of traders. Because if traders who trade on the weekly chart are seeing a downtrend and continue to sell, traders who are on the daily chart see the same downtrend are continuing to sell. What does that mean? It usually means the sellers are in charge, and no matter what time frame we're on, we want to do the same thing. So now we want to move down to the 4-hour chart, and we can see right in here. Again, now normally when you're doing this, I would not necessarily have the moving average here on the lower time frame. Um, I shouldn't say that it's not necessary. I always have it on because I really want to make sure that I'm really got that wind at my back. I like walking downhill better than walking uphill. I like the wind at my back rather than the wind at my face. I like trading with the strong trends on multiple time frames rather than trade against the trend. I mean, it's just something that, you know, it makes it easier to be profitable. And if it makes it easier to be profitable, boy, you want to hang on to that until it just doesn't work for you anymore. But on the 4-hour chart, we can see we've got our ABC moves, and we know that by checking out the daily and the weekly chart beforehand, that those markets are out. That's where we can confirm that the downtrend is attacked across a variety of different time frames, and that means that we got the potential for some sweet trading opportunities on here. Now again, if you're selling in here, it really doesn't matter a whole lot what you're using. Again, the simple ABC pattern that we talked about before, or we can put a technical indicator down here to help us time those entries. It really doesn't matter, but if you're selling in this kind of environment, you really are increasing your chance of success on the trade. I mean, that's just kind of common sense. And if you're buying here, I mean, you better be quick on that trigger, and you're not going to be looking for a 1-to-2 risk-reward ratio, because the market's not going to give you the opportunity to stay in that long to realize that big of a gain. But only if we're trading in the direction of the trend can, and I say the audacity, because there are still plenty of traders who don't believe a 1-to-2 risk-reward ratio is possible. I'm here to tell you it's more than possible. It is being done by many, many traders. Like I'd mentioned before, I'm originally from Chicago, and I cut my teeth in the bond market in Chicago. And I know that there are traders down there who have been down there for 30, 40 years who use a 3-to-1 risk-reward ratio. If they're risking, $500 on that trade, they're looking for $1,500 in potential profit. And they had been doing in that for years and years and years. And, it just makes sense. If people have been doing that for a number of years and they're still doing it successful, then why to try to do something different, And, when you're down there and you see these traders, and you understand how much money they're making, how successful they've been, how disciplined they are, and the simple strategy that they're using, I mean, first of all, it takes you a little bit of time to really grasp that it can be that simple, okay? It can be that simple. It can make that much sense, okay? But that's something that we have to work through and work our way through that wall, to buy into it. But we've got a nice 4-hour, downtrend on this, or a nice downtrend here on this 4-hour chart. And this is the kind of environment that we want to look for to take advantage of using multiple time frame analysis. Let's take a look at another one and get a little bit closer. Now, y'all remember what this was? Yeah, this is what happened when a central bank comes out and says, I know we wanted to keep the Swiss franc at about 120 on the euro, but we're not going to do that anymore. We're just going to let it float. Well, it doesn't float. It free falls in that type of environment, and that's exactly what happened. But of course, it got overdone. Like I said, markets can have a lot of emotions. They're living and breathing, and they do get overdone on one side or the other. But that's what creates our stair-step formation. That's the kind of thing we look for. That's what we want to embrace. We don't want to be afraid of it. We want to look for it. But now, since then, we see the market has been moving its way back up. And, it's definitely, I mean, almost parallel to the 100-day simple moving average, or excuse me, we're on a 4-hour chart, the 100-period simple moving average, and continuing to move its way up. So we go down to an hourly chart, and we can see here's a nice little area in here. Now, where on a shorter term time frame, we see, it's almost parabolic. Okay, now some traders will just trade this. A lot of traders on the second won't have that moving average in there. They'll just have a way to identify entries and exits. But we want to use 3 time frames. So I've got the 1 hour and the 4 hour. That's my 4-to-1. And also keeping with that 4-to-1 ratio, I'm going to use the 15-minute. Remember, 4 15-minute blocks in 1 hour. So, and here's something, that we have. Again, it's been dipping through. If we're going to use that, we see one trade right here, right in the middle of it, where we see our A, B, C. Market moves up through this level. We place a protective stop over here. We use our 1-to-2 risk-reward ratio, or if these professionals who are using a tighter approach, we use a 1-to-3 risk-reward ratio, and market just continues to move up until we hit our profit target. Okay. Now, I say that like it's easy, where we just stay in the trade until the market moves up and hit our profit target. But I'm here to tell you, out of everything that we do, that is the difficult part. And eventually you'll learn that. Eventually you'll see that. And that's what's called the patience and the discipline of not messing with the trade, letting it move out. Because what if this market, you got in here and it moved up here, and then it moved back down, but then it moved back up and you're okay, you're feeling good, but then it moved back down lower to where your entry was. Okay, do you have the strength? Do you have the discipline to stay in the trade, to take advantage of the trend? If the answer is yes, you'd be rewarded. If the answer is no, you turned a winner into a loser and you got out prematurely. And I call it, the more you mess with it, the less you're going to make. Okay, but that's what trading is all about. And that's why I say it's simple, because the process we're using to identify trades can be simple, but I'll never say it's easy, because the human emotions want to take over that decision-making process, and we got to fight that. That's what makes it difficult. Okay, so it's a simple approach to trading, but it can be difficult to maintain that discipline and confidence in what you're doing on a constant basis over time. That you've got to earn on your own. Okay, here's the U.S. dollar. We saw Greg McLeod was talking about the U.S. dollar. It's a basket that is mostly the euro, a lot of the British pound, Canadian dollar. It's a basket of other currencies, just to kind of give you an idea of what the U.S. dollar is doing on a regular overall, because the U.S. dollar is also a futures contract, and there are traders who trade just the U.S. dollar. But this is a 4-hour chart. We're just going to use 2 time frames here. Okay. But look at, we talked about this with the moving average before. This is sweet. This was going on from July till October. So it's not like you have to be quick on the trigger. It just played out in front of us. And if you remember, for those of you who were in yesterday's CFD, we looked at oil, we'd see the same thing to the downside. These markets do trend strongly. We just need to take a little bit of time to identify them. And those are gifts to us. We want to think of it that way. That is the goddess of trading saying, okay, we'll make it easy for you here, but I want to see if you're going to take advantage of it. We want to learn how to take advantage of that. We want to learn how to seek those opportunities out. They're there. We just have to recognize it. Now, here's one way to recognize it. We're moving above the 100-period simple moving average from about July. There you go, until October. So let's go down. This was a 4-hour chart. Let's go down to an hourly chart and see if we can find some trading opportunities. And here's a nice strong move within that time frame, and it's pretty easy to see these ABC moves and how they played out here. It was just, one after another. And remember, at the end of a trend, you're likely to find yourself in a losing trade. That's okay, because if you were there from the beginning of the trend, you may have found yourself in 3 or 4 winning trades in a row if it was a strong trend. And if I can catch 3 winning trades, I'm willing to take a loss on that last one, because remember, it's a 50% win ratio is our goal. We want to make more when we're right than we lose when we're wrong. So I'm willing to take that losing trade at the end, because I don't have a crystal ball. I've been doing it for decades, but I have no idea when the trend is about to end. The only thing that I can look at is what I talked about before. You look at the economic calendar for a potential end to the trend. And for instance, if I saw a trade set up right now in the euro dollar, I would not take it, because tomorrow morning is that non-farm payroll, and that could feasibly change a trend. Will it? Well, it's not likely. What does not likely mean? Well, not likely means I don't know, and nobody really knows. But I'm not going to stand in front of non-farm payroll and announce to the world that I don't care, because I do care. But In the meantime, we've got all these ABC moves that we had talked about, buying and getting the 1 to 2 risk reward ratio. And you can see that each of these lows are higher than the previous low until really right here. That's not really much of a move. But obviously, when it moved down through the moving average, it definitely did. So we can see, one after another potential trading opportunities because we took the time to identify a market that was offering something that we're looking for. Okay, and that is really the key to what we want to do here. Which is really why I say we used to have a lot of traders ask us, I want to be a specialist on the euro dollar. And I'm not big on that. And that doesn't mean that you can't do that or you shouldn't do that. But let me rephrase that by saying that just never really worked for me. I mean, I tried it. I started off in bonds, and trading bonds was great. There is so much liquidity in the U.S. bond market that the moves can be very, very easy to identify and very clean. But at the same time, sometimes the traders don't know which way the bond market's going to go, and you're sitting there watching. It's like watching paint dry. I mean, you have no idea which way this market is going, and you just don't see any trading opportunities. So obviously, because I was familiar with bonds, I worked my way over to stock indices. Why? Because the same numbers, non-farm payroll is the same, the central bank announcements are the same, they react similarly or they have the same reaction. So if I'm in tune to one set of numbers, I started trading the other financial markets. And then I was doing stocks and bonds, and then I started looking at currencies. Because again, it's the same thing. These markets are very related. Money can go out of the bond market and into the stock market, but money can come out of the German bond market and come into the U.S. bond market. But before it does that, those euros have to be traded, and they have to trade to become U.S. dollars, because you can't invest in the U.S. bond market in euros. You've got to invest in that U.S. bond market in U.S. dollars. Just like for money managers who want to buy the German Bund. They have to take those dollars and exchange them for yen, or excuse me, I was just seeing if you were paying attention, to change them for euros before you can buy the German Bund, because they are traded in euros. And so these markets are very related, and you can almost see the ebb and flow from one market to the other. So when you've got a strong trending market in the US dollar, there might be a reason why. What is the reason why? Well, let's look at the stock market. Well, the stock market is screaming to the upside. So a lot of traders around the world want to be in the U.S. stock market because they think it might be the safest one right now, or they might think that the U.S. bond market is the safest. Sometimes your return of your investment is more important than the return on your investment. Getting your money back is more important than how much you're making, right? So, I mean, they're related to each other. So a lot of times when you'll see one trending, you'll see the others trend. But if at the time that you saw that where the bond market or stock market was not trending, but you'd have some currencies trending, then you ask yourself, why? Well, because it's their interest rate environment. Or it might be the oil market, which is something that I didn't trade. But the oil market, the price was reflected in the Japanese yen, which imports all of their oil. The Canadian dollar, they're a big exporter of oil. So the Canadian dollar will usually rise with a rising U.S. oil market. So those are the kind of things that we want to be aware of, but at the same time, we want to seek out those strong trending markets to be able to take advantage of them, because they are usually there, whether it be on a longer time frame chart, a medium time frame, or a shorter time frame chart. They are there. It is our job to seek them out. Okay, let's go to another one here, and let's go to the Aussie dollar. And we can see that the market is moving down strongly below the 100-day, or this is a daily chart, 100-day simple moving average, just a series of ABCs, which you could take advantage of right on that chart. But if you want to be a little bit tighter and take advantage of it, we move down to the 4-hour chart, and we can see this strong move below within the larger move on the daily chart. It's a little bit easier to see these ABCs, and we got the same thing, just one after another, potential trading opportunities. And this is the kind of thing that we want to do when we're looking for these trades and using multiple time frame analysis. I would recommend just the 2 time frames to begin with. There may become a point in time where you really find that it works for you and it just makes all the sense in the world, and maybe you want to take on an additional time frame, but it really isn't necessary. But just make sure you're using that. We're going to show a chart here in a minute that we'll go to. As a matter of fact, we can go to that right now. We just want to make sure that we are using the time frames that are close enough to each other where we can see the same trending move, but not so close to where we're kidding ourselves as not looking at through a different set of windows, so to speak. And again, I like that 4-to-1 ratio, but sometimes it works out to 3-to-1, up to 6-to-1, because obviously there are 6 4-hour blocks in a day and 5 daily blocks in a week. But like the 4-hour, 1-hour, 15-minute works out to a 4-to-1 ratio all the way across. Whether you want to trade on the hourly chart and use the 4-hour chart to help you identify the strong trends, or use the 4-hour, trade on the 4-hour chart and use the daily chart, or if you even want to trade on the 2-hour chart and use the 8-hour chart. We have that flexibility by trading the Forex markets because they offer it to us. And we want to make sure that we take advantage of every angle or every edge that it is offered to us. And all these different time frames is a big deal. And also the 24-hour nature of the market makes it a little bit easier to identify those trends. And because we don't have all those gaps like you can often see in, for instance, stock market products, indexes, the cash market. You see just lots of gaps because there are a lot of things can happen overnight these days. Even though a market doesn't trade 24 hours, you better believe that the news events or unscheduled news events or just situations around the world continue to happen in spite of the fact that the market isn't trading. I mean, the nerve of them. I mean, for the European Central Bank to come out and make a big announcement while the U.S. stock market is closed really just isn't very nice of those guys, right? Obviously, it's got nothing to do with reality. The reality is that these days we have to be aware of what's going on around the clock 24 hours. Use that to your advantage. And like I say, even traders who trade on a 5-minute chart use a 15-minute or a 30-minute to identify the direction of the trend, just to make sure that you're just not seeing a counter trend move within a bigger trending move. And that's what we want to avoid. We want to avoid, we see that 5-minute chart moving down and we tell ourselves, well, we're in a downtrend. Tom said, look for sells. But if we look at that 15 or 30-minute chart, we can see that what we've identified was a downtrend is just a counter trend move on a longer time frame chart. That's where we can get into trouble. That's where we can find that we sold at a bottom or bought at a top, and that's not very fun. But if we just look at the longer time frame to make sure that they're agreeing with each other, common sense will tell you that it just increases our chance of success. And that's really all we're looking for, is just looking for those edges to keep increasing our chance of success. Because eventually, if you work at it and you identify little points that increase your chance of success, guess what happens? You increase your chance of success overall, and you find yourself all of a sudden becoming a break-even trader, working your way to becoming consistently profitable. Okay. And again, here's another example of what we're looking for. We got the short term, which is the side street. I mean, we really know that we want to go, say, into the city, but on the side street, it really doesn't show us the way. We first have to go to the midterm, which is a regional highway, and then going on to the long term, which is the expressway. That is the way we get to the city, say from the suburbs or from a rural area. We're taking advantage of 3 different modes, 3 different time frames, if you will. Even though it is a side street, a local highway, and a major highway, it is the same concept that we use the 3 of them. Otherwise, if this is, say in, somewhere, in the U.S., obviously it's in U.S. because I'm seeing Pleasant Run Road here. We have to know how to get to the highway before we can be successful, before we can successfully get to our destination, okay? And we want to think of that with the same time frame chart. We want to make sure that we've got all of our ducks lined up in a row, just to make sure, just to help us with our overall profitability or effectiveness as a trader. When those tumblers are lined up, and combination is correct, the lock is going to open. Until then, it's not. We want to think of multiple time frames in that same fashion. When the price action on those charts are aligned, and the smaller begin to move in the direction of the larger, you are employing multiple time frame analysis in your trading, and you're increasing your likelihood of success on the trade. I want to go back one more time. Now that we looked at the charts and we've talked a little bit about it, take a look at this again one more time, because this is really one of the keys to it, and it really does kind of show you what it is that we're talking about and what it is that we're trying to take advantage of. This type of drawing or graphic has been around for decades because many traders understood this process long ago and have been trading that way for a long period of time. And remember, if we're using the 2 time frames, say the 4-hour, just make sure that 4-hour is moving down, and then we can take advantage of those selling opportunities that we see on the hourly chart, because the hourly chart is moving down and the 4-hour chart is in agreement. So we're kind of exploiting 2 time frames that can only help our trading results. Or if you want to use the 3 time frames, just make sure that daily is moving down, the 4-hour is moving down, and to trade on the hourly chart. I mean, that is really lining it all up. That is really trading like a professional. And that is really trading by taking a step back and taking a look at everything instead of having your nose on the screen and just looking at one time frame at a time. The more information that we can process, the more information that we can use in our decision-making process to identify our trading opportunities, the better off we're going to be. I mean, that's not trading. That is about life in general. In closing, let the long-term time frame determine the direction to trade. Let the shorter-term time frames get in sync with the longer-term time frames. Multiple time frame analysis can be used as a part of any trade analysis, and using multiple time frames will provide more insight as to how the pair is cycling and therefore how to best time an entry. Okay, thank you very much for joining me. Stick around though. We got Dan Perry is going to talk about the benefits of management accounts here. Oh, in about 16, 17 minutes. And remember, after Dan, he's going to be doing that $500 account raffle. We had a winner yesterday. We're going to have another winner today. And there's another guarantee. It's not going to be me. But I got over that when they told me in the beginning that I wouldn't be allowed to be in the raffle. And also for giving us feedback on the boot camp and opening up a live Aura FX trading account. By the end of the month, you receive $50 to start trading. Again, that is just an incredible promotions by Aura FX, and it really shows the confidence that they have in our ability to help all of you become better traders. And of course, we have that confidence at the same time. And Aura FX as a firm is just stepping up to the plate and backing it up with real money. So, that is a great thing, and I hope everybody is willing to take advantage of it. Other than that, this is my last webinar for this boot camp. I want to thank each of you for joining me. I mean, the number of people who have started with us at the 7-hour process is very similar to the number of you who have stuck around the whole time. We certainly appreciate. I know that sometimes we can go on, and I know I can go on in rants, and I just really appreciate your patience by taking it all in. And I certainly hope that we get a chance to work again down the road sometime. Certainly, would like to see that you guys take advantage of this situation, and that we can someday, or maybe someday, you can share some information with me that'll help me with my trading. That is a true goal of mine. Other than that, thank you very much, and good luck with your trading. And stick around for Dan. He's going to be on in about